Good morning, everyone, and thank you for joining us for our Q4 2020 webinar for the Prescient China team and funds. We are joined today by Liang, CEO of Prescient China, and Tian, who heads up the product and business development for our China business. Prescient China was formed in 2009 with the China Balance Fund launching in 2013 and the China Equity Fund launching in 2018, with the team being based in Shanghai since 2016. The Prescient China business manages just shy of $400 million with strong flows and performance over the last quarter. Tian and Liang will be recapping on the China and global markets for 2020, the current Chinese global market valuations and outlook, looking into a little deeper into some highly valued companies, capping off with our current portfolio positioning and performance. Please make use of the Q&A function throughout the session if you'd like to pose any questions to Tian and Liang, and we'll be sure to answer them at the end of the session. Over to you, Tian and Liang.
Thanks, Jason, and thank you everyone for joining our session this morning. So I'm going to take everyone through a bit of a market and economic update and covering both sort of politics, markets, and COVID. So I'm going to start again with what has been the topical issue of the past year, COVID-19, that's been affecting markets. So a quick summary of where we are: the US still leading the way in total cumulative cases. If we look on the right-hand side, South Africa doing relatively well compared to all the major countries, with China's figures almost non-visible, total cases of just under 90,000. If we move on to COVID-19 death rates, it's almost inverted, with US and India showing much lower death rates, but also that's because the total cases are much larger. So with a bigger denominator, your death rates are lower, but either way, we feel that's a positive. With the strain getting weaker as we move on, and also the vaccines coming through. Speaking of vaccine, the latest vaccine situation is quite focused on developed economies, the economies that can afford the vaccines, and none actually being administered in Africa yet, including South Africa. But if we look at the green spots on the map, a lot of the world's major economies are already getting their vaccine programs underway, and that's a very positive sign for us, and hoping that we can get a high vaccine coverage rate by the end of this year. If we look at ranking in terms of countries, US and China leading the way in terms of total number of doses administered, but as a percentage of population, the Middle East actually coming tops, with Israel topping the list at 40% population coverage, UAE coming in second at over 20% population coverage. We expect the percentage numbers to continues to start climbing as vaccine production ramps up and government efforts push throughout the quarter and throughout the year. Moving on to GDP growth, as previously expected, China, the only major economy for 2020, posting a positive economic growth, with the economy expanding 2.3% for the year. The rest of the numbers are still all estimates, but all remaining major economies expecting economic contraction for the year of 2020. South Africa faring pretty badly, with an expected economic contraction of 8% for the year, although still slightly better than the UK. If we look at how China's GDP has really rebounded this year post-COVID and the effective sort of treatment of COVID-19, you can see the sharp drop earlier in 2020 and the sharp recovery once everything got under control within the country. And with the rest of the world contracting, China's share of the world's GDP has taken almost a parallel shift upwards, and by 2024, 2025, it's expected to be close to around 16% of the world's GDP, catching up to the US as the world's largest economy. So I think that's quite a positive for us investing in China. If we move on to another topical issue, which is the China-US relation outlook, especially with the incoming Biden administration. So we see quite a lot of positives with the incoming Biden administration. But that doesn't mean everything's going to be smooth sailing. So we expect Biden to calm China-US relations compared to the previous Trump administration, simply because we expect the new administration to have a lot more sanity, if I can call it, in terms of policy implementation. Markets should know what they can expect, rather than unexpected moves by the government. Biden's administration has also appointed a strong sort of Secretary of State, and they do view China as a major geopolitical competitor. So we do expect China's US relations to remain sensitive, although slightly better than what we have seen for the past 4 years. We feel that US domestic policy will be a focus for the new incoming administration, taking some limelight away from foreign policy. So we are hoping for some more calm in terms of international relations, and that should be positive for both US and Chinese markets. COVID-19, another topical issue, and as Biden's sort of election promise of 100 million doses of COVID-19 vaccines in 100 days plays out, if it's successful, we expect that to be very positive on both the economy and the markets. Some further positive changes that we expect from the Biden administration: potential easing of visa restrictions between China and the US, reversing of the expulsion of journalists, potential reopening of the consulates that were closed last year, and definitely restoring certain bilateral dialogues to improve communication between the two governments. So all of these are positive. We also expect a potential easing of the China-US trade war, because we believe that it is in the US national interest, and I will go through that in a little bit more detail after this slide. But we do expect the tech war in terms of US national security and national interest to continue, and that's part of the competition that we expect to continue to see between the two major powers. We look at what has happened in the US-China trade war. The line just after 2018 on this chart shows when the previous Trump administration first imposed tariffs on Chinese imports, and we can see that it hasn't really had the impact that the Trump administration has hoped for. China's trade surplus with the US continues to increase and is still increasing to this day. If we look at China's exports on the chart on the left on this side, China's exports to North America, it's taking a much, not a much, but every year it's becoming less and less relevant in terms of China's total exports. So it actually doesn't affect China as much as it does affect US consumers in terms of higher costs. If we look at foreign direct investment, Chinese investment in the US has dramatically dropped since 2016, whereas US investment in China has remained fairly consistent throughout the period. So what we can see from the stats is the US suffering more than China with the trade war, which is why we believe it is in the US's national interest and people's interest, consumers' interest, for the trade war to at least take a breather. So we are hoping for that positive development. If we look at why we feel the trade war is not really practical, China's manufacturing GDP as at the end of 2019 was more than the combination of the US, Germany, Japan, and South Africa combined. So we can see why there is actually no alternative to China's massive production capabilities for US consumers. And if tariffs are imposed, US consumers will just continue to pay for that. So with that said, I'm going to move on to a stock market update. If we look at 2020 stock market performance, this is all in US dollars. We can see China definitely the top performer with the yellow line on top, simply because they recovered quickest from COVID-19 and never had the major dip back in March compared to all other major stock indices in the world. If we look at absolute numbers in terms of performance, China topping the list at almost 37% in dollar terms. The US, Germany, and Japan also posting strong positive returns, with JSE and UK doing quite poorly in terms of dollar performance, although JSE much better than the UK. If we look at stock valuations, the 1-year forward PE ratio, again, I think we've showed this chart in our last webinar as well. The PE ratios or valuation metrics continue to rise. This means that the company earnings aren't necessarily rising, just the valuation multiples. And that's why the markets have been rallying. If we compare the US markets to China, the average NASDAQ PE index PE ratio is close to 68, S&P around 30, whereas China is valued at 20. So even though we believe the Chinese stock markets are currently not cheap anymore, it is still much, much cheaper than its US counterparts. So if we do experience a major correction, we would expect that China will correct less than the US, and vice versa. If markets do continue to rally, we feel China has slightly more room to rally compared to current US valuations on average. So I think in summary, the world markets have really rallied since March 2020, the lows of March 2020. If we look at the S&P 500, the US benchmark, it's done more than 68% since its March 23rd low in 2020. and China is up 69% as well, pretty much identical over the same period. So I think the core question we often ask ourselves in the investment team is, with so much stimulus globally, when will the rally end? And it takes us to the famous quote by Warren Buffett, and says, be fearful when others get greedy, and be greedy when others are fearful. And right now we can say with quite a lot of certainty that we are quite fearful of market risk going forward, both in terms of Chinese equities, US equities, and world equities, just simply because of the current valuations we are sitting on. So with that comment, let me take you through some crazy stock performances of 2020. So the first slide, I'm not going to start with a stock, but the first line on this chart is actually Bitcoin, cryptocurrency that's often linked to extreme volatility. For the year of 2020, Bitcoin's return was around 300%. If we look at the next line on this chart, BYD, which is a Chinese electric vehicle and R&D sort of conglomerate, its return was 400% for the year, around 400%. Next on the chart is Tesla. Everybody is aware of Tesla as a company. Its return was around 750% for the year. And lastly, Chinese electric vehicle company NIO, which is listed on the NASDAQ, returning a whopping 1,200% for the year of 2020. So with these sort of returns, we almost feel like Bitcoin, which is often associated with massive volatility, its returns more appear like cash. And we really believe there are some crazy market sectors delivering some crazy stock returns, and I'll cover a couple of examples that I did mention now. And we are really fearful of this, which is why we are quite fearful of sector risk going forward from here. So firstly, I think Tesla, a company that everyone is aware of, they make electric vehicles, currently have a massive market cap of around $835 billion. If we look at their business, they delivered close to 500 vehicles for the year of 2020, which is quite a small number, especially given the market valuation. Their PE ratio is valued at close to 1,400, which is, in our view, probably by any standards, very, very high. So to give you all a comparison, Tesla's market valuation is larger than all of these car companies on the right combined. So companies like BMW, Mercedes, Fiat, everything on the right-hand side of the slide combined make up 824 billion market cap. So it just gives you an idea of how high Tesla's valuation is, and on an equivalent basis, Tesla would have to take over the market share of all of the companies on the right-hand side combined to be able to at least somewhat justify its current market valuation. If we move on to the Chinese electric vehicle company NIO, a very much similar company to Tesla, currently with a $95 billion market cap. It delivered much less vehicles compared to Tesla, 43,000, almost 44,000 vehicles for 2020. It's currently loss-making with no clear path to profitability, so significant risk of closing down in the near to medium future. And if we look at its market cap, it's almost double companies like BMW, Honda, Hyundai, and more than double Ford. So again, it gives us an idea of how high the valuations are and how much the market has rallied, probably beyond normal investment norms. If we move on then to BYD, which is also a very highly valued company with a 369 PE ratio as of 26th of Jan. It's a much more diversified business. It does electric buses, it has battery technology, and it also does electric vehicles, pictured on the left. It's got a 99 billion market cap. Even though it's valued very highly compared to Tesla and NIO, it actually seems like good value. And this is why we feel the markets in certain sectors are what we term crazy at the moment. So with all these crazy companies out there, what are we doing as Prescient China? I think what we are doing now is sticking to our tested quantitative process. So what we try and stay away from is profiting in the short term by jumping into these crazy and unjustified rallies. So as an example, we do not hold NIO, and we are holding underweights in companies like BYD, just sitting at very, very high valuations. So in times like these, when these high value companies continue to rally, our outperformance will suffer slightly, but so far our performance for 2020 has been in line with the market, and gross of fees, we have outperformed the market for 2020. And going forward, we feel we are well positioned for the market if there is a correction that does come through. So with that, I think I'm going to pass on to Liang to take you through our current portfolio positioning and processes.
Thank you very much, Tian. And as Tian mentioned, what I'm going to try to do is zoom out a little bit and just give everyone a bigger picture of what we try to do as a manager and how we're doing. So to me, very, very essentially is how do we add value as a manager? And essentially, we do two things. Firstly, we pick stocks, looking for opportunities to outperform the market. And secondly, although stocks is the right answer for the long term, there are huge cycles in the market, such as the Chinese market, and we believe by actively doing asset allocation, we can reduce the risk and increase return. Ultimately, our objective is to give our clients high real return over the cycle, over the long term. Right, so kicking off, in terms of any business, as a quantitative manager, how do we see the market or how do we see the world? So the quantitative fund manager, what we find very, very simply is that over the long term, the equity market goes up and all investors together, sum together, get back to the market. However, the market itself is made up of thousands of stocks and hundreds of factors. And what we mean by factors or risk premiums, or there's multiple ways of different quantitative houses like to name them. Essentially what it means is you have portfolios over the long term that are high quality, high value, that outperform over the market over the long term. And then you have other portfolios such as momentum, which have massive, massive cycles, but in a market such as China, over the long term, actually underperform. As a quantitative manager, over the long term, what we really do is have really, really good data, being able to identify the economic factors that make sense, combine them together so that over the long term and over the cycle, we beat the market. We do all of this without predicting the future. But any factor portfolio or any kind of investment away from the benchmark has drawdowns. And this is where we really put into our risk control and our ESG process. So to our risk management and ESG, what we really, really do is look at how much of a bet are we taking every individual stock. So a perfect example, for example, in South Africa, typically you have managers that are either all in on Naspers or out of Naspers, right? And what ends up happening is your entire portfolio is just driven by one bet, which is Naspers. And here in China, it's a similar thing. In our risk management process, we get away from all of that. We diversify away these individual stock risks. We diversify away sector risk. We diversify away currency. We look at companies with bad governance and avoid those. And we look at companies with a terrible environmental record. And once you manage to put all of that together, what ends up happening is you start outperforming on a more stable basis. They have a more smoother outperformance. Once we put that together, at the end of all of this, we of course also look for arbitrage opportunities, which is small opportunities that are relatively risk-free that allow us to outperform the market. And at the end, we end up with a process, our China equity process, that outperforms the market. So animation and stuff are great. Does it actually work? And I'm glad to say yes, it does. Over the long term, our equity portfolio looks very, very similar to the index. Over the long term, just starts outperforming very, very well. And in spite of the struggle in the last few years, as Tian mentioned, where we have a very momentum-driven market, we still manage to keep pace with the benchmark, and over the long term, outperform it by around 2.5% annualized after fees. Right. So what are some of the biggest opportunities we see? As Tian previously mentioned about the crazy stock, well, actually, the entire momentum portfolio is reasonably crazy in China. So over the past 2 years, what you've really seen that the momentum portfolio, which historically had a PE of around 22, has risen to a PE around 50 as a portfolio. So we're talking about over 50 stocks out of 300 in the CSI with an average PE ratio of over 50. If you break them down to each individual names, these stocks are not small stocks. Typically, they make up anywhere a market cap between 100 billion CNY to a trillion CNY. All of them trading at a PE of 50 to 150, all of them with a return of the last 12 months of above 100%. And combined, they make about 22% of the portfolio. So what does this mean? Although a few of them will become the Amazon of the future and become some of the biggest companies in China, it is actually impossible for all of them to win over the long term. This creates one of the best opportunities to avoid these stocks and outperform the benchmark, creating value for our clients. But taking a step further, arbitrage opportunities still exist in China even right as we speak. Currently, there's two big things we do. Number one is something we call future arbitrage, essentially buying the market slightly cheaper. So you're actually just buying the index slightly cheaper. And we hold those to maturity and we outperform the index. The second big opportunity in arbitrage we've spoken about before is, of course, AH arbitrage. Once again, we're talking about dual listed shares listed in China as well as Hong Kong. And due to a variety of reasons in Hong Kong, currently these shares are extremely depressed in Hong Kong. So in China, some market leaders may trade at a P of 45 to 50. You can buy the exact same shares in Hong Kong at a P of 8. And we believe that although China may be over bullish on these shares, Hong Kong are certainly over bearish on these shares. And over time, as they come back, it'll add a lot of value to our portfolio. Right, moving on, as mentioned, in spite of the tough market conditions over the past 2 years, in the short term, our equity portfolio has done just as well as the benchmark, and since inception, we're outperforming the market quite healthily. More importantly, when compared to the largest CSI 300 ETF in the world, so another way to get exposure to China equity is, of course, just to buy an ETF. What you can see that here we're looking at live data of our China equity fund since we started the fund, net of fees. And when you compare to the largest CSI 300 ETF, we're beating them annualized by over 2%. And if you look at the carve-out data, which we had all the way back to 2013, it's the same story. We're beating the ETF by over 3% since inception. But taking on to the next level, equities alone is great and beating the market is great, but what else can we do? In the China Balanced Fund, of course, what we try to do is do asset allocation. Today, I'm going to share with you one chart that it's in a very, very famous book. It's written by Kindle Berger, and it's called Panics, Manias, and Crashes. And this book has been around, if I'm not mistaken, almost since the 1960s or even earlier than that, and just shows how the world never, ever changed. I think before you dive into valuations, before you dive into economics, before you dive into everything, it's very, very useful just to zoom out and really just think about where we are in the market. So in Kindle Berger, when he tried to idealize what a cycle in the market looked like, he said it goes through essentially 4 phases. The first phase is something he called the stealth phase, where the really smart money get in, where the valuations are cheap. So I would liken that to about 2013 when we launched a China fund, where it was very difficult to convince people about this idea of China. But if you really did your research, you kind of found, wow, this is almost a once-in-a-lifetime opportunity of how cheap this market is. The second phase of market growth through is the awareness phase, where everyone starts understanding the story, understanding the market, starting to buy into this asset. And over this period, of course, there's also corrections, or what he called a bear trap. So it's people who still not bought into the story, then starts dumping it and dump it too early. The third phase, he walks into something called the mania phase. This is where you have a lot of media attention, you have enthusiasm, you have greed and delusion coming into the market. And what I like to point out is that if you sit today, whether you're looking at China or whether you're looking at globally, we can clearly tell ourselves that the world and China, we're all in the mania phase, right? We have a lot of media attention, we have a lot of enthusiasm for risk assets. People are like, wow, we missed out last year, returns are so good, we have to invest. And we're getting towards a stage where, as I've shown you on the overall PE ratios, where people are really starting to believe in possible futures. And finally, later on, what we're going into next is, of course, the blow-off phase, where it starts crashing. There'll be fear, there'll be capitulation, there'll be despair. And us, as an asset manager, we're trying to maneuver through this mania phase, which can last multiple years, which have huge return, and more importantly yet, is also being able to act in the blow-off phase to ensure that we do the right things. So taking a step, zooming in, what are we seeing? Well, we're seeing the economic model. The Chinese economy is growing probably the strongest that it ever has over the last 10 years. We don't think the economy has ever been stronger since 2010. And at the same time, due to COVID, you have monetary policy and fiscal policy, which is reasonably easy and benign, building up this mania phase, this bubble. If you look at valuations, once again, as Tian mentioned, although the Chinese valuations is as expensive as it's been since we launched the fund, it is not nearly as expensive as the USA, a lot of other global markets. So individually, there are pockets, there's still pockets of value. Not everything is at its extremes, And that's also why we do understand that this mania phase could end right now, but can also continue on, because simply globally in the world, we have this perfect conditions to make a bubble. And finally, as you know, in terms of Prescient China, we've always said this, in China, sentiment is important, as sentiment is noisy. And currently, sentiment is very bullish in China, as we look at it. So in terms of the balance fund, what are we doing? Well, what's next for us? Firstly, when equity valuation get higher and higher, we're going to start cutting. And we're already in the process. We've done a little bit currently. And then after that, we're not actually going to go short, because there's no way of you knowing when the bubble will peak out and how long can this go for. So we're only going to go low equity when the sentiment changes, when sentiment can move extremely quickly in China. And that's the importance of us being on the ground here in China every day, processing the latest information. And once again, when the crash happens, and it always does, and people get depressed, there'll be too much fear passing to China, we will then buy the market aggressively. And this process can take weeks, months, or even years. And that's where we add the value, right? Why do this yourself? Why sit there, go through the stress, unable to see, when here we are in China, looking at all the important things and making these decisions over time. The next slide, all I want to show is even in the last 2 years, how quickly we move our asset allocation. The blue line is the equity market, and the red line is our equity exposure. And you can see how active we are in changing our asset allocation. And that comes through the fact that there's a lot of news, a lot of information that come through all the time. And by dealing with it systematically, on average, we'll get out closer to the top of the market, and on average, we'll invest closer to the bottom of the market. And I'm happy to report that overall, over our 8-year history, Prescient has been able to do this extremely successfully. So you can see here over the long term, China CPI over the entire period of 8 years has done about 80% or roughly 10% per annum, whereas our fund has outperformed 65-35 market benchmark and CPI by an extremely wide margin. Last year, of course, has been a phenomenal year for the fund. It was up almost 37% just last year. And since inception, when we started the fund 8 years ago, the fund has done almost 19% annualized, compared to Chinese CPI plus 3 of 10.2%, delivering almost CPI plus 12, plus 11, plus 12 kind of return the whole period. By delivering such high returns, we're also glad to report that last year we were the number 10th ranked fund out of 1,200 funds in South Africa. And since inception, we're ranked number 2 out of 500 or so funds that still survive to today. So interesting fact, when we launched the fund, there was over 760 funds, but of those 760, only 555 are still around. And finally, when we talk about the China fund, we have always said that China provides diversification benefits. And one of the ways that you can really see is in this chart, we're showing what our China equity and China balance fund look when compared to other top SA global equity funds of a variety of managers of some of the biggest names in the SA market. And once again, it shows what we've always said, that China always does something different to the rest of the world. And that's a benefit for clients holding our fund, is that not only does it deliver high real returns, but it really provides a good diversification benefit putting together. So I'm just going to conclude and we can take some questions. So just to conclude, the world is in a difficult situation. It's very unique in the sense that we actually have extremely weak economy around the world, but with the world at extreme valuation based on this belief that we have this endless stimulus. This is not a good position to be in. This is very scary. Now, if you look at China, it's a little bit better. In fact, a lot better. It has a stronger economy, it has far less stimulus. However, it will still be influenced by the rest of the world. Overall, the global market is no longer cheap. I think the high real returns that we've had historically, I think all clients have to lower that expectation. I think the ideas of 20% per annum sitting where we are now in global valuations is extremely unlikely to occur over the next 7 or 8 years. However, we believe China is still a good opportunity. And as a Prescient China team, we believe that we provide a great solution for all their Chinese investment needs. And of course, for something like the China Balance Fund, you can leave it all to us. And once again, we'll make those hard decisions when it needs to be made. Thank you very much. I'm going to stop there and open up for some questions.
Great, thank you very much, Tian and Liang. There are quite a few questions coming through. If you do have a question, please make use of the Q&A function and we can get onto them straight away. So here's the first question that's come through. How would you say there's a high risk of the Chinese government making a monetary or policy error by removing stimulus too quickly?
I think the Chinese government is very, very aware of this. And I think what they've done, even very, very recently, is kind of repeatedly stressed. Number one, Chinese government has a lot of bullets to fire. So unlike the rest of the world, they still have a lot of capacity for stimulus if required. And number two, they'll be very balanced and slow in their approach. So I think the stimulus era is far riskier on the other side, which I think what the global world governments are doing, which is keeping monetary policy too easy should the economic recovery come through. So I think China is, so why are we so not 100% negative, bearish right now? Is precisely as you've said, right? So China is in this unique situation where it has a strong, very, very strong economy. It should be hiking monetary policy, should be tightening, but they're avoiding that, trying to find the balance, don't want to end this, while not quite certain how coronavirus will affect everyone else. So if everyone else gets into a second recession, then China obviously don't want to over-tighten as it occurs. So that also brings me back why it's actually very likely that we have this perfect environment for a bubble, which is also why, where we are saying you need to be aware of this, you need to be careful. It's not going to be smooth sailing, it's going to be difficult. And you really, really, really have to focus and make the right calls going forward.
Perfect. And then just maybe just touching a bit more on that last answer you just gave now, is what are the sort of signs we need to look out for when bubbles are being created, and how far can these things be stretched? Or is there anything to kind of look back on from past bubbles?
Definitely. So Jeremy Grantham, of course, talked about back in the days as he ran up into the Nikkei, right? So the Nikkei were the same thing, I guess, over that period of time. So they went short the Nikkei at a P of 35, saying, whatever you would believe about the Japanese economy in the 1980s, this is obviously cannot be extrapolated to the end of the world. At that point, when they went short Nikkei, the Nikkei was really 40% of the entire world indices, right? The Nikkei peaked out at 60% of the entire world index at a P of 65. So it went up another 100% from then. And that's starting on a base of 35. During the IT bubble in the S&P, it's exactly the same thing. Lots of people got out of the IT bubble in 1998. P's are extremely high. And once again, from 1998 to the peak in 2000, the market almost doubled. Right. So once you're in crazy, there's no limit to crazy. Right? So once you're in P of 50, there's no difference if it's P of 80 or 100 or 150. And I think those are the things that we're looking out for. Is that it started with very, very few stocks rising to those valuations. It's starting to expand a little bit like a cancer, where more and more and more stocks are starting to go in there, right? So logic has become, oh, well, if Tesla's so expensive, then go to the next one, right? Go buy some NIO. And oh, if NIO is so expensive, go to the next one, go buy some Great Wall Motors, etc., etc., etc. And that logic is not sound because they're all competitors to each other. So that was my earlier comment where all of them can't all win, right? So if one of them justifies a ridiculous P, it means that it's expected him to take over the world, which by definition means that other companies cannot do that. When all of them get there, it's scary. So this thing could really go on for quite a long time. And that's why I'm saying the timing is impossible to tell. And it's absolutely impossible to tell, which is why it's important to be flexible and be quick in your asset allocation, right? Which is why it's only possible to do it, as I've said, as a professional, looking at this every single day with a lot of different news. You don't know when something that's material, when something's immaterial. You do a hell of a lot of research to try and put all these things together, and you make a lot of decisions in a consistent manner so that when you put all the decisions together, you're more right than wrong on average.
Perfect. And then maybe something you can touch on here, Tian, that you brushed on it a little bit earlier. So with Biden obviously taking over office and improvement, a little bit of improvement in sentiment, does that reduce volatility in the Chinese market? Is it correlated? And if not, what sort of contingency measures or plans does the fund have in place to kind of counter this volatility?
So with Biden coming through and what we can say at least surface level sort of some tensions easing is definitely we feel is positive for markets. So one very practical example is during Trump and Mike Pompeo's last couple of weeks in office, there were quite a lot of Chinese listed companies that were placed on the entity list and the US military list. So that actually creates very practical issues for investors, especially investors with any US connection. So a lot of passive funds potentially had to disinvest. A lot of clients with US or fund managers or that had clients with US connections had to disinvest from a specific number of stocks. And it makes fund management actually quite difficult. And obviously the negative flows to those companies would affect the stocks and in turn affect the Chinese markets, which then theoretically contributes to increased volatility. And we don't expect these sort of sanctions, or at least unexpected sanctions, to pop through as much under the Biden administration. So that is definitely what we feel is a positive under the new administration that's come through. But overall, we feel, so depending on how China-US relations play out, it feels like over the past 4 years, we really had the worst of the worst, and it's actually more difficult for us to get worse as an increase Chinese market volatility due to Western investor sentiment rather than the other way around. So we are positive on that.
I think adding to that, I'm just going to add a little bit to that. So I think contrary to other people's beliefs, I think one of the most interesting things is that the 4 years Trump's been in power has resulted in the Chinese equity market increasing by around 69%. And this is in fact one of the best performances of the Chinese equity market under any administration. So I think that's important to point out. I think with Trump in place, what it has created is that opportunities for us to buy equities a lot, but people are very, very negative. So if you recall about 2 years ago, where the market would truly absorb in the story of Trump and China going to war and on this massive thing, we kept telling our clients, for us, it's actually the opposite. It's one of the most attractive times to buy the Chinese market. It drove the valuation so low, gave an opportunity to create value, and vice versa, as we see it with the Biden administration, that although volatility may decrease due to less noise, it doesn't necessarily mean we'll have an easier time. Valuations are higher, and the actions that Biden are going to take will create less volatility, but at the same time, perhaps does impact China in a more material way. And that's something to watch out for as well. So I think it's very, very important that as a balanced fund where you have such flexibility to asset allocate, that we're on the right side of these type of shifts as things change. And finally, as previously also mentioned, a lot about our risk control, right? And one of the risks in there is precisely exports. So in terms of the overall portfolio, we ensure that if we're buying value, we don't get into a trap where we're buying everything that's been sanctioned by the US. That's likely to get you into big trouble should these things get worse. So that's some of the ways we tackle this issue.
Perfect. And this is maybe a bit of a question that's more pertinent to obviously both of you being based in Shanghai. Electric vehicles are obviously quite topical, and were quite topical in your presentation today. And what's the sort of rollout? How does it happen in China versus or someone like the US? Obviously, China's got some very strong electric vehicle producers coming through. Is there sort of an incentive in place for Chinese people to adapt quicker?
Yeah, definitely. So many brands in China, so many brands in China that produce electric vehicles, a lot of government incentives. So we are based in Shanghai, so probably one of the cities with one of the worst congestion problems in China, probably second only to Beijing. A lot of pollution issues across China. I think that's pretty well known globally. And the way government incentivizes vehicles, specifically in Shanghai, as an example, is if you buy an electric vehicle, you don't pay GST, which is equivalent of VAT on vehicles in Shanghai. So that can be anything between tens of thousands of rands to hundreds of thousands of rands, depending on the model that you go for. And I think the cherry on top is that in a city like Shanghai, for you to own and operate a petrol vehicle, you need to buy a number plate. So in South Africa, we're used to getting a number plate, buying a license for a few $100 a year, paying a couple $100 for the actual cost of the number plates, putting it onto your car. But in a city like Shanghai, the number plates for normal consumer vehicles cost on average around 250,000 Rand. That's before you can purchase your car and get on the road. So that's a massive, massive cost that the government has completely scrapped. So if you buy an electric vehicle that's been approved by the government, and all electric vehicles, fully electric vehicles do qualify, is that you don't pay sales tax and you get a free number plate that allows you to freely drive in Shanghai. So in China, it works slightly differently, where if you are living in Shanghai and driving in Shanghai, but you don't have a Shanghai registered number plate, you cannot travel on all roads. You can only travel on certain designated roads, but if you do have a local number plate, you're free to travel on all roads within Shanghai. So these are at least financially massive incentives for the government, and it's probably one of the policies we were speaking earlier today that keeps Tesla going and keeps companies like NIO going, because if these policies weren't in place, there would be a lot more competition for the electric vehicle manufacturers, at least from conventional vehicle manufacturers, because the car costs themselves are actually much less. But if you combine it with number plate concessions and sales tax concessions, it actually becomes quite a bit cheaper than conventional cars if you go for an electric vehicle. And in terms of overall charging capabilities in China, at least in Shanghai and major metropolitan cities, it's very, very widespread, very convenient. I'm actually not sure how it compares to places like the US, but if we consider city density, population densities, it would be probably a lot more easier to set up networks in places like tier 1, tier 2 cities in China compared to Western countries where population densities are just much less.
I think China is a world leader in terms of charging capacity in the world. I think living in China, it becomes very, very clear that electric cars are going to be the future. I think on the incentives level, I'm extremely impressed at the foresight that the Chinese government has setting up this entire value chain. So China was too late to the party of normal cars. We'll never catch up to BMW, Porsche, Volkswagen, everything. But what China has done extremely well is to create an entire electric vehicle supply chain. Everything from batteries to software to smart cars to AI, connecting it all together, providing the right incentives for people to set up in mainland China to ensure that the next revolution of electric cars, China is going to be close to the forefront. And all of it funded by a bullish capital market that's willing to fund all these crazy projects at PEs of infinity, essentially, right? So where they're talking about NIO or Liang or all of these Chinese electric car makers funded by Western capital at a ridiculous valuation in order to create industry in China. So I think the entire thing is just incredible to watch. Is that not only that China as a country is gaining all these capabilities, but it's gained it at the price of selling ridiculously expensive shares by Western capital. So it's very, very impressive what they've done. Just kind of shows, policy foresight, coherence in policy, and building for the long term.
Fantastic. And then maybe just in closing, I've got two more questions here. First, I'm going to get them to you both now. So how do you manage regulatory risks, for example, like what happened to Ant and Jack Ma, for example's sake? And then secondly, how does MSCI China differ to A-Shares China, which is obviously used in your equity fund and as a building block in the balance fund?
Sure, maybe I'll handle the first one and I'll give Tian the second one. So in terms of regulatory risk, there's quite a few things that we do. So number one, we do make use of an external ESG provider that goes into every single industry and kind of explains the governance and regulatory risk to us. So we have a high, medium, low regulatory risk matrix that every company will show. So they will show, for example, in this sector, in the mining sector, this is standard practice. These companies take low risk and these companies are taking high risk in these things. So that's the first thing that we look at. Number two, in spite of what people say, typically the regulatory risk comes when you're pushing right at the edge. So Ant Financial is a perfect example of a business who's kind of straddling the old world and the new world, taking finance and pushing right at the edge. And we're certainly not doing that. So we stay within what we should be doing in China. And that takes away a lot of the regulatory risk that you're looking at. The direction of regulatory risk, especially in the financial market, also very, very clear. In the 8 years that we've been in China, the direction always been in the area of more opening up. They have never gone back on something that they've previously opened up on. So as an investor in China, I think you feel reasonably safe that things are getting better and better as the years go on. So Tian, I hand over to you for the MSCI.
Yeah, so I think actually quite different, the MSCI China versus CSI 300, which is our benchmark. So MSCI China is what we often term China offshore. So it's mainland Chinese companies that are listed offshore, which includes Hong Kong. So Hong Kong is a special jurisdiction within China, and it's freely accessible by Western investors from all over the world. So MSCI China mostly consists of Chinese companies that are listed in Hong Kong and also the US. So, for example, the company we mentioned earlier, NEO, that's listed in the US on NASDAQ. So Chinese companies that's listed essentially outside of mainland China. But the main issue we have with MSCI China is that it actually doesn't really cover companies that's a good representation of the Chinese economy. And in addition to that, there's high concentration risk within MSCI China. So companies like Alibaba and Tencent pretty much dominate the index. And last we checked, the top 10 stocks within MSCI China make up almost half the entire index. So if you decide to have any sort of view on the top 10 stocks, that pretty much makes up your entire return, your sort of make or break positions. Whereas CSI 300 is mainland China focused, so it's not freely accessible by everyone in the world, but we feel is a much more real representation of the Chinese economy, much less concentration. A lot of the MSCI China companies are also listed in mainland China with dual listings, so we don't lose as much coverage. And the top 10 stocks represent within the CSI 300. So the top 10 out of 300 represent around a quarter of the index. So the makeups are quite different, the characteristics, the return characteristics are also quite different, but over the past 5 years, the total return, the overall return hasn't been that much different, but we don't necessarily expect that to be the case going forward. And I think lastly, what we feel is the most important is that the mainland China CSI 300 has much lower correlation to any Western equity market out there. So as an example, whether it's to the S&P 500 or to the JSE All-Share Index, the mainland Chinese CSI 300 is much lower correlated and provides a much better diversification holding within a global portfolio compared to MSCI China.
Fantastic. Thank you very much, everybody. And that concludes our webinar for today. If you feel like you need any information, please reach out to your Prescient consultant, and we'll be sure to answer any further questions or information you may need. Thank you once again, Tian and Liang, and enjoy the rest of your day, everybody.
Thanks, everyone.
Thanks, everyone.